It can take months or even years testing, researching, and finding a profitable system in the markets. A profitable trading strategy can be a ticket to a funded account and lots of trading capital. But what if your strategy stops working? Trading strategies can stop working over time. There is no rhyme or reason to this, but over the years, strategies can face drawdowns and stop working within the markets. There are ways to avoid this, however. In this video, we are going to look at why trading strategies stop working, how to identify if your strategy is working, and what you can do to avoid the problems that come with the strategies eventually not working anymore. Let's not wait anymore and get right into it. Regardless of its complexity and moving parts, no system is immune to failing over time. Some of the most profitable trading systems in the world have stopped working after years or decades after very profitable streaks. The reason why strategies fail is simple. The market is constantly changing and evolving all the time. Institutions change how they trade, how money is moved, and eventually, as conditions change over time, this can eat at your profitability until your strategy or system eventually becomes not profitable. Of course, this can also work in the other direction. Sometimes you'll see your profitability increase over time as the conditions change. It's impossible to avoid this fate. No matter how well you craft your trading system or how many indicators you add to it, there is always a small chance that it's eventually going to stop working. So the ultimate question is, how do I know that my system is no longer working and I should pivot my attention to other strategies? Sadly, there is no way to identify that a strategy is failing in real time. The reason for that is simple. If you take a strategy that is profitable over 5 to 10 years, there are going to be months and quarters when that strategy is not profitable. Does that mean that the entire system is unprofitable? No, it doesn't. The trading strategy will be still profitable over a long term. And this is where the argument gets a little bit tricky. As a trader, you want to limit your exposure to strategies that are having a rough quarter or a rough year, obviously. However, without the benefit of hindsight, that is practically impossible. And this, of course, needs to be taken with a pinch of salt. If your trading strategy was never profitable, it's going to be hard to know if it's failing now. To identify whether a strategy is profitable, you'll need to backtest it over a long period of time. And by a long period of time, I mean at least 2 to 5 years worth of data. During this backtesting, you should get an idea of the maximum drawdowns and loss streaks that come with your strategy. For example, if you know that over the past 4 years, your exact strategy had a maximum drawdown of 4% and 10 losing trades, then if you're losing more than 4% now, you know that your strategy is clearly failing, or at least you know that it's currently not profitable. This, of course, could be a rough patch and just a drawdown and nothing to worry about, or this could be the effect of ever-changing market conditions making your strategy not viable anymore. Ultimately, you need a lot of backtesting data to be able to make this decision, and you should not stop your strategy until you have that data at your disposal. So we have established that you cannot really prevent a strategy from failing over time. But what you can do is hedge your chances and hedge your risk to avoid combining on the drawdown on multiple strategies. This is where diversification comes into play. There is no need to stick to just one trading strategy in the markets. There are thousands of possibly profitable strategies for you to use. Many traders that have stood the test of time have 4 or 5 profitable strategies that they trade on different accounts or even with different prop firms. As one strategy becomes unprofitable over time, these losses are mitigated by the profits from the other strategies. After a few months have passed and you see that the strategy is not performing well, you can pull it out of your portfolio and limit your losses there. At this point, you would want to tweak that trading strategy to make sure it once again fits the current necessities of the market and the current conditions. What is important is that these trading strategies are not correlated. When running the backtests on your data, make sure that you use it across the same forex pairs, for example. Then you come in and you compare the different balance graphs. If the peaks and valleys correlate between the two strategies, you should not be trading them at the same time. You wouldn't want to run these systems at the same time because the losses will add it up as they are correlated and they're probably going to be losing and winning around the same time. So, in summary, trading strategies will sometimes stop working over time. However, there are new strategies appearing and edges being developed in the market. To stay safe for the long term, limit your risk, and have a couple of strategies that you can use in the different times of year or whenever they're market conditions change. You need to be looking at your trading over a long period of time, not just days or weeks. That's why having multiple uncorrelated strategies in your trading portfolio can be a really great idea. Aim to create 3 to 5 profitable strategies to be traded at any given time, and you should be able to mitigate the risk of any one of them failing. That's probably the best chance you have to ensure long-term profitability. If you want to learn more about how to become a sustainable, profitable trader, I'm gonna put the link to our website down in the description below. And if you have any questions for me, leave them in the comment section. If you want to get in touch with us, feel free to message our 24/5 live chat or send us an email at info@luxtradingfirm.com. My name has been Oliver. Thank you for watching and have a great one.